Whoa, the chat just jumped with a bunch of questions to start the day, so that'll be interesting. All right, welcome everybody to episode 35, I believe, of the Volatility Barometer. Today we're going to talk about quite a bit of the VXX debacle still, but I do want to leave plenty of time for the Q&A because last week we did 2 live streams and they ran a little long because we had a ton to talk about. So you've probably got some lingering questions. We'll make sure that the Q&A section today is a little bit longer. And of course, the main reason why you're probably all here is I will try to structure what I feel is the safe-ish trade for trying to dip a toe in the water for this volatility thing with the VXX debacle. There are ways to trade it, both long and short. I'll get into that. But people are probably interested for me to narrow it down to just a single trade, and then I will open up an account and actually take the trade. So that'll be interesting. See if everybody agrees with my trade, disagrees. You can all leave your opinions after I say what my thoughts on the matter are. So unfortunately, my usual business partner is not with us today, my little cat. She's going through a rough time. She's been in and out of the hospitals the last few days, and tomorrow's a big day. We've got MRIs and CAT scans and all kinds of stuff. So she won't be here today. I know people always comment about her. She'll be back. She'll be back strong. She's a good cat. Unbelievable how expensive medical treatments on cats are. It's insane. Far more than on humans. So that's a good racket to be in for sure. But all right, everyone. So thank you very much for joining me, of course. Let's hit you with a little bit of an intro, and then I do want to roll through this VXX stuff quickly because I can see there's quite a few questions there. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, I'm just scanning these questions here. We got some stuff, looks like, on the UVXY Butterfly that we took in our trading community. So I will get into the pricing. I'll show everybody quickly what that looks like, of course. And a few other things about shorting VXX. I'll probably get to some of those as I'm talking, but certainly at the end, if I didn't get to your question, we'll get through as many of those as we can. So do me a favor, of course. You don't have to pay. Live streams are always free, but entry fee is a like. So trick the YouTube algorithm for me. Make sure that everybody hits the like button. It is free. It takes 2 seconds. So please do me that favor if you would be so kind. And let me start the show. So first of all, again, I always remind people, these are mostly for my organization. I mean, this is just quick little notes. But the first thing, basically what I'm going to be doing here, because my email inbox, of course, blew up last week and over the weekend, I can't possibly answer that many emails. I mean, probably, I'm not kidding, probably 1,000 questions. So what I did is I just opened them all. I just was reading all day long. And I'm just going to pick out what I feel are 5 or 6 of the most common questions and try to handle those. And then probably in the Q&A section later, we'll get to many more. So the first thing that people are always emailing me is it done yet? Is the announcement? Where do I find the announcement? So the first thing that I want to show people is what it's going to look like when the announcement comes. So remember from last week's live stream, I showed you that if you type in, this is Thinkorswim, if you type in VXX minus VXX.IV, this is the VXX Nav value, what it is currently trading, minus the VXX indicative value. That's what the IV stands for. And you can see that what it should look like is a flat line here, where those authorized participants that we talked about last week, they do come in and they make sure everything functions normally, so the supply and demand is basically taken out of the equation, and it tracks the underlying methodology of just tracking the underlying index. Remember, I always reference this, but the VXX essentially, while the VXX, the VXY, these are ETPs, they actually do track an underlying index. And that's all managed through Barclays share creation and, of course, those authorized participants. So that's what you're looking for. Essentially, if you want to know if this nonsense that's going on is still active and we're still waiting for the announcement, you don't really have to scour the internet for the Barclays announcements. You don't have to look on Twitter. You can just look in your trading software. If this line is above where this flat line is, if it's above the zero line, it means that the share creation is still halted and everything is still in limbo, basically. If you want to do it, maybe you don't have Thinkorswim. If you want to just do it Yahoo Finance style, you can do that easily. It's just a little bit different. So you type in VXX, that would be the NAV value, right? So we can look at that, and that is trading at 25.19. This is what it's actually trading at. But if you type in the, why do I always forget what those things are called? I knew it every time, and then when I just blank out in the live streams. I don't know. Put that little symbol, put VXX-IV. So Thinkorswim is a dot IV, Yahoo Finance is a dash IV. That's going to give you the indicative value, and you can see it should be trading at 21.76. So that's why there's this gap here. It's about a $3.50 gap. You can get that on any trading software. I've never used, Fidelity or Schwab, but I'm sure you can just get the tickers yourself. This is what you're looking for. So clearly it is still going. The share creation has not been resumed, and this thing is still broken. So that's the first thing. An amazing amount of questions on that. And of course, you can follow a few people on the volatility space on Twitter. You will see the announcement quite quickly. There's going to be quite a few people that, through various ways, it's going to be released quite quickly. So don't worry about that. The second question that I'm getting a lot of is people are looking at this chart and thinking that nothing's really happening, and the NAV and the IV value are basically flatlining. And that's not entirely true. It looks like that. It looked like it went really crazy at the start, and then now it's kind of fizzled out and nothing's happening. But you have to remember that these are absolute numbers. So this is $3.38 right now above the indicative value. But the indicative value of the VXX is changing day to day, moment to moment, based on how the VXX is moving around. So of course, if that value is getting larger or smaller, that absolute value is also going to be a different number. So I've got a little chart here showing the actual IV over the NAV when you look at it through a percentage lens. This is the NAV trading over the VXX. Because the VXX has been going down the last week, it was in the highs of 28.80, I believe. Now it's down pretty low. It gives the appearance that it's flatlined when in actual fact, the IV over the NAV, or sorry, the other way around, the NAV over the IV is actually growing. Now, it's not growing a lot. I'm actually quite surprised, to be honest, that it looked really crazy initially, and I thought we would see more of this. This action here, while it's just a steady, slow raising of the percentage, it does lead me to believe that it's possible there's something else going on, some other mechanism perhaps that they have that I'm personally not aware of. Perhaps they learned some lessons when this happened in 2012 and they have a few backup plans, and it hasn't really gone crazy because, to be honest, this is kind of a good setup. As everybody knows, we did several live streams on AMC and GameStop and gamma squeezes and short squeezes. And that's not my style of investing. I'm not I mean, I wish people luck, and I kind of enjoyed watching it go, stick it to the man and all that. I support retail traders trying to, get one over on the short hedge funds. It was great, but it's not my style of investing, so it's nothing that I would do. This is sort of a perfect setup if you think about it, because volume has crushed, as I'll get to in a second. I'm actually a little bit surprised it hasn't gone. I don't know where everybody else feels about this. I was sort of expecting it to decouple a lot faster than it has. But so far, not a whole lot of action. But just remember to, when you're looking at that value, if it's $3, if it's $4, that does mean a different percentage. So right now, this is as of market close yesterday. The IV is actually about 18% below where the VXX is trading. So you can view that. That's basically how much premium is in this trade, essentially the moment they resume share creation, because what's going to happen is there's going to be a big gap down as soon as that happens. So you can look at these charts as sort of how much juice is actually in this trade. And right now, not as much as I thought. So the third thing is a lot of people asking, can you trade it? How come people are still trading it? We can actually see in the volume what would be expected is there is a huge drop off in volume as well. So we've got a chart here. This is showing essentially how much money is going through the VXX on a daily basis. This is the VXX daily volume times the VXX Nav value since January 1st, 2021. The reason I chose this date, essentially just recent activity. We want to see where it's been recently. And in the last, year or two, it's about $1 billion a day is going through this product. But you can see the VXX it's dropped off a cliff here. And if we look closer and we zoom in as a percentage compared to the average volume for the day, this is somewhat expected because the market's been very turbulent lately. So we would expect a product like the VXX, it would get not only more action, but the price has also gone up significantly. So the amount of dollars going through it is growing, of course, during a crisis. But now it's down 88% based on relative to the long-term average of about $1 billion. So we had about 110, 120 million only going through this thing. So something to be aware of that, yes, the volume is dropping quite a bit. It's another thing that I thought would lend itself a little bit better to maybe the Wall Street Bets crowd getting on this thing, because what you would actually want to happen, because you can't short this thing and because there's no share creations and there's no redemptions and everything is basically supply and demand on a product that can't be shorted, you would expect that the only missing piece would be you want lower volume going through it. So it's down 88%. It's kind of looking like a pretty decent setup. I suppose that's good news, that maybe people are looking at this from a risk management perspective, thinking that, look, if we try to push this thing really high, this trade is not in our control. I mean, you could push it as high as you want. You could get everybody going, get the right Reddit forums or whatever they are. I'm not really into that world, but if you get this thing going, Barclays makes the announcement, and it's not going to matter how many people are on this thing. It doesn't matter how many forums this thing goes through. It's going to go back to the indicative value. So perhaps it's a good sign that the Wall Street Bets crowd, at least the leaders, so-called leaders, if there are any, don't know how the system works, sorry, but maybe they've just thought, this is probably one we're going to skip because Barclays has the power here. It is just a ticking time bomb, and that NAV value is going to go back to the indicative value at some point. Nobody knows when. It could be a month, but that is going to happen. Okay, the fourth thing. This is kind of an interesting one. So, and I'll ask you guys before. Actually, I did a poll on Twitter. The next one is what I'm going to ask you. But basically, this is important to cover because at some point, we don't know when, couple days, maybe one day, maybe a month from now, but this thing is going to get fixed. And the question that I posed to everybody on Twitter, if you go to my Twitter account, while I'm opening this up, don't forget to follow me on Twitter. It is @VolatilityVix. That's the handle. I did a little poll recently where I asked everybody, when Barclays Bank does resume share creations on VXX, and it is again tracking its indicative value normally, will you use VXX? Tons of people are emailing me saying, is this broken forever? What are we going to do? If it starts trading, do we have to go to VXY? Do we have to, use UVXY and then factor in the 1.5 times leverage and change all our trades. It is really going to depend on you, but I'll give you my take on it. So the first option for people to select from was, yes, they will continue to trade it when it is fixed, because as long as the NAV is tracking the IV, as long as that share creation mechanism is functioning normally, the product is fully fixed and there's no reason not to trade it, right? So just my 2 cents, I'm probably in the first camp. I may not jump in on day one. I guess there's no reason why I wouldn't, but perhaps there's a little bit of emotional scarring there. People are a little bit hurt that this happened, and some people did actually get financially hurt, so that's going to be a major problem. Totally unfair situation. I am not at all trying to defend the bank here. This was awful. They didn't tell anyone ahead of time. It's just terrible when things like this happen. But when it is fixed, in my opinion, it is basically fixed. Second option here seemed to be the most popular one, 47%, nearly half the people that answered here. VXX is dead to me. They're never going to trade it. It's just off the board. And I had a lot of people even being more aggressive, like I'm going to sue them and ETNs are garbage and the regulator should ban every single ETN on the market. I don't know where I stand on that. I mean, honestly, like I said in the previous live streams, 99.9% of the time, the difference between an ETN and an ETF is really, practically speaking, a non-factor. But people do have to know that ETNs don't actually hold the underlying securities, whereas an ETF is a fund and it does hold the underlying securities. So when you're holding an ETN, you're basically holding an IOU, debt obligation from the bank to say that I will honor this price. You know, there's a layer there. So people think it's done, it's over. The one thing that I will point out, and if that's your opinion, that is totally fine. I'm not here to convince anybody of anything. But you have to remember that this exact same thing happened in 2012 with TVIX. And for about a month, the TVIX NAV decoupled by about 90%. And it took a whole month for them to fix it. And then when they did, sure enough, within a couple days, it snapped back down. I suspect this time it's going to happen quite quickly. But back then, it happened within about a 2-day period. Snapped back down, $300 million is just wiped from people's accounts. Lost all the money. Of course, they don't have to announce it ahead of time. They've got plenty of lawyers who have just poured through those prospectus with a fine-tooth comb. They are totally covered. They can do whatever they want. So that's what's going to happen again. A lot of money is going to be taken away, and people are going to be hurt. But TVIX did come back. People eventually thought, well, they just forget, I suppose. You have to remember in 2018, after the Volpocalypse event, when XIV, that old favorite long-term short vol product, that was terminated. The SVXY, which is materially identical to the XIV, it didn't accelerate their product. They were down 95% on February 5th. They did not accelerate. The UVXY, no reason they would have accelerated, but they also didn't. But on February 27th, because of that incident, both of those ETFs actually switched their leverage factor. So the SVXY went from a -1 times inverse, exactly like the XIV was, and the UVXY went from 2 times. It was structurally identical to the old TVIX. It dropped down to 1.5 times. So a lot of people don't know that. They're trading UVXY thinking that this has always been this way. It is not. It used to be 2 times for about 6 years when it launched. And what ended up happening there, because the ETFs are not connected to the options market, the options market was adjusted with the deleveraging factor of the UVXY. So what's going to happen to people's options when that happens? Well, banks don't have to tell people anything. So a whole bunch of people woke up that morning and their options were just adjusted on them, and a bunch of people lost money. Same thing. Well, look at the volume on UVXY right now. Look at the volume on the UVXY options market. That's one of the reasons we love UVXY, is because the options market's pretty decent. VXX is probably better, but UVXY is pretty solid. People didn't really last that long. I remember back then, a lot of people were saying, this is it, I'm done, volatility ETPs are broken, they're manipulated, we're going to sue them, let's, Twitter polls, we're going to band together, get 1,000 people to petition, and I support it. They are protected legally, so unfortunately there's nothing that can be done, but people came back. So my thought is, most likely there's going to be some emotional scarring. People will not like it for a while. People like me who, understand that really the functioning of the product is quite basic, and VXX has been trading since 2009. This has never happened. I don't trust banks. I never do trust banks. I don't trust elites. I don't trust institutions. You guys know that. I don't trust the Fed. I don't like any of them. I'm an equal opportunity offender. I don't like either political party, all of that stuff. But with respect to this product, when it is fixed, in my mind, it will be fixed. So that's where I stand. People just wanted to know what I think about it. I will definitely trade the VXX in the future. No reason why I wouldn't. I mean, I'll mix it up, though. There's a VXY, there's a UVXY, there's other options as well. But that's just my take on it. It's probably, in my mind, it's not broken. It's just, once they fix it, probably good to go if you can get past the emotional scarring that they have done to us. Okay, so number 5, very common last week. Has the VXX Nav value always been in line with its indicative value? Essentially what they're asking is, have those authorized participants always done a good job keeping this thing in line? And the example people gave me was, if you actually do the VXX minus VXX.IV, and we back up to 10 years, what are we going to see? Should see flatline the whole way. It is flatlining all the way here for quite a while, but it seems like the authorized participants have not done a good job at all before a certain date. Seems like it's all out of whack here, and then they figured out how to do their job right here, and everything is functioning smoothly. So what a lot of people were saying is, well, because of the Volpocalypse event, maybe they had some regulators come in and fix the problem and teach them how to do it correctly. So I want to do a little poll before I give you the answer. I want everybody in the comment section, I'm just going to keep an eye on it for about 20 seconds. Does anybody have any idea why in about April 2021, hint, hint, the authorized participants seem to have started to function correctly when before that date, they were not functioning correctly? Does anybody in the comment section know the answer? Hopefully my comments are enabled here and everything's good. So I'm going to watch it there, and I'm going to watch it on the YouTube channel. And let's see what people say. Wouldn't you know it, my comment section is frozen. So I might just have to give the answer. I was hoping to see everybody's response, but you know me and my problems. Okay, I see a couple of comments here. So you ready for me to give you the answer? Seems like somebody knows the answer. So essentially what it is actually true that it has always functioned well. The VXX is a well-functioning product with share creations on one side that is marked down to the indicative value, and then on the other side, anytime there's a deviation between the NAV and the indicative, those authorized participants can come in and basically smooth it out, arbitrage the difference, and everything's fine. Why in April 2021 is this chart all messed up? Well, the short answer is in April 2021, that was the date of the last reverse split. So what ends up happening with a reverse split, these softwares are not really connected very well with each other sometimes. And when you have something that happens abruptly like that to the price, it's going to throw everything off. But if this was an adjusted chart going back, this is just answering all those people that asked this specific question, it would actually look pretty smooth. If you remember, there's been 6 reverse splits. This is the VXX live pricing since it launched on January 29th, 2009. Now, this is split adjusted. VXX never traded at $400,000. It launched at about $100,000. $100. But every time you do a reverse split, of course, you're multiplying by 4. So you're just going, 100, 400, 1600, and you just keep going. When you look at it backwards, it looks like the thing went from 400,000 down to 26 bucks. It is down 99.99%, but every time it gets low, they do a reverse split, the price goes back up, and the whole system continues. This is an insurance product. It's not broken, it's not manipulated, it functions exactly as it's supposed to, but this is what insurance products look like on a long-term chart. The thing I told everybody in the last live stream is, if you were to have some method of charting your car insurance over time, it would look like a chart of the VXX. That's exactly what your car insurance would look like. Your fire insurance on your house would be a chart of the UVXY. That's what it would look like. So, yeah, it is just a reverse split. Happens quite regularly, but it will throw off the trading softwares going back. It's just one of those things. Unfortunately, they're not able to update it. It's kind of similar to if you look at a chart of anything like the when they changed all the ticker symbols for the cash fixed term structure. I know there's some softwares that are still using the old, God, what were they? VXV, and instead of the VIX 9D, the VXV, VXM, the midterm. Those are years ago, and they're still using those tickers. So just keep in mind, sometimes charting going backwards is going to give you the illusion that something terrible has happened when actually the answer is quite simple. It was just a simple little stock split. Don't think that, oh my God, this is so nefarious and these things don't work. They actually function really well. And now, the big trade. So here we go. Now, the one thing I want to be clear about here is I'm not telling you what your bias should be. This trade, if you want to trade the VXX, if you want to jump in here and have a little bit of fun, that's totally fine. I'm going to do it as well today with a live trade. But you have to remember that this trade works both sides of the trade, but it has a lot of moving parts. So if you want to skip this, if you want to sit this one out, that is just fine. This is a very rare event. It does not happen very often. But I do want to remind people that this does work on both the short and the long side. So remember from our live stream last week, if we go to the VXX, I covered 6 option trades that I think are safe-ish, right? There's nothing safe in this environment. We have no idea what's going to happen. Barclays is in the driver's seat, and nobody is going to be told ahead of time. Like I said last week, people are saying, oh, I have a rumor, I have a friend in the industry who told me this. I don't want to insult anybody, but they don't. Barclays is not going to give out any information to us regular people. So there is the short method. I went over 3 of them. This is the short call vertical. Fine trade. Nothing wrong with this one at all. That one is still there and it's still available if you want to go look at that previous live stream. If you want to see it, I believe it was number 34, but I'm going to just check that so you don't waste your time. Should be labeled correctly. Top 6 VXX options trades, episode 34, just recent. You can watch the full thing and you can get an idea there. The second one I went over was just an out-of-the-money put butterfly. And here's the price right now. So essentially that's just looking for the snapback when they announce the share creations are resuming, and it's probably going to gap down. So that's a decent trade as well if you take a short bias. And then the good old iron condor. You could move this further down if you wanted, but again, it's probably going to gap down about $3, $4, and that's just going to throw out a fairly big net to trap where we expect the price to be. Now, just a reminder, remember duration is your friend here because we don't know when this announcement is coming, and if you're going to be short this thing, the only way you make money is if it gaps down. If your trade expires before they announce this thing, then your trade is just going to expire, and it's probably not going to be a very good trade. So duration is your friend on the short side. On the long side, it's the opposite. Duration is working against you. You're hoping that the Wall Street Bets crowd get their hands on this thing and take it to the moon, right? So you could do something like this. Doesn't have to be this extreme, but this is a long put vertical or long call vertical where you're putting a very little amount of capital to work and you could potentially make a lot of money. The reason we use a vertical, of course, is because volatility is very elevated right now, and you don't just want to do a long call on its own. You're paying an awful lot of money up front for that premium, and so the vertical has both a short and a long strike. It just reduces the vega a little bit on you. The next one that I said is a broken wing butterfly. I like these a lot. I trade them a lot, and in this instance, it would work pretty well. You put up a very small amount of capital, and if you get the Wall Street Bets crowd going, you can make some money there. Then the last one I covered was the calendar, which kind of the same deal, covers a very large range, similar to an iron condor, just slightly different bias on the Greeks, but that would work as well. So, what am I going to do? Well, I'm not going to do any of those. I'm going to do one that's almost identical, but just a different name. So first of all, we must use a limited loss trade. So again, my token reminder to everybody that volatility can go extremely high, way higher than we think it can do. These things can just do crazy things that you look back and you think, wow, I never thought that could happen. It really can. So just to give you an example, the old oil and gas ETF, when they suspended shares, the DGAZ, I believe, DGAZ or Z, depending on where you're from. I didn't follow it closely, so my numbers might be off, but I think it was up something like 12,000% or something. So I'm not saying that this is going to go 12,000% above its indicative value. TVIX went 90, so that's quite significant. But just know that you do not want to be taking an unlimited loss trade short, knowing that that upside is there. Even if it's a small possibility, you don't want that action. So we're definitely going to want to do a limited loss trade. And the other thing, of course, we have to be worried about here, like I said, is volatility is very elevated right now, so you don't really want to be buying either long calls or long puts. That's a bad trade. It's probably not going to work out. So this is the trade that I am going to do. Now, let me just walk you through why I feel that this is probably the one. This is the one that I think is the safest, the one that's going to make a decent amount of change, and probably not get too out of control. So if we go to, say, 30 days out, remember, duration is our friend. We need this trade to have an expiration date longer than the expected announcement. Now, I don't know if it's a day or a week or a month, but 30 days, given that this is a limited loss trade, I think 30 days is enough. I really think they're going to fix this within 30 days. If they don't, then this trade could be in trouble. Unless, of course, the VXX decays on its own, but it could be in trouble if that's the case. So what we're looking at is we just need to open a long vertical. We'll choose the strikes later. So we could do something like this. And this is what the long put vertical option looks like. It is a long 23 strike right now, and it is a short, let's call it a 22 strike. Now, as far as strike selection goes, where do we want to set this trade? Because remember, the announcement, the advantage that we have here is that we kind of know that there is about 350 in juice here. So what we could do, if you just prefer to use Yahoo Finance, we actually could just set the strike price at the current VXX indicative value, so about $22. That's what it should be trading at. We could just set our strike price at $22 and say, oh, there's an announcement, hopefully nothing major. We could just say that that's the baseline case. It is going to gap down to $22, and that's going to be the end of it. And you're going to leave this trade on. You can see you're risking 45 to make 55. That could be a fine trade. You're making a little bit more than you get, but remember, the price here is going to gap down at some point. So that's what we're counting on, is that the indicative value of where this thing should be trading today is actually here. So you're going to get a really nice bump when that announcement comes in. Now, there is a second factor to this trade. I think I wrote it down. Again, these notes are just for me. I already talked about the unknown variable number one, Barclays, when will they fix it? For the short trade today, remember, we want to stretch it out a little longer because we don't know when that announcement is coming. But the second aspect that you could factor in if you wanted, and you don't have to do this because this is a trade on top of a trade, so to speak. The first variable is the Barclays mess, is the indicative values and setting those strikes and timing the announcement. That's the first aspect of this trade. Most trades just have the trade. This one has that extra stuff. But let's not forget that the VXX is the VXX, and we're talking about a trade that is 30 days expiring. So if you want, and adding additional layer, you can start trying to factor in the actual decay factor of the VXX and set your strikes even more accurately if you'd like. So the one thing that I'm going to go over really quickly, this is a super simple way that you could do it. I do it a little bit more detailed, but this is a general audience. So within our VTS community, I have a lot of volatility metrics in our dashboard. They're all useful for different things, right? So this may not mean much to you, but all of these metrics are used for me in all of my different strategies. So we've got 4 at VTS, we've got 10 at VTS Options, and they're all useful to me. The one that's called VXX Crush Level is essentially factoring in the current volatility environment and all the metrics and showing how much the VXX is going to decay, all else being equal, in one day, given all of these metrics and where the market is currently trading, with the VIX futures and the term structure and all of that. 0.35% down per day. So it is decaying. We do have positive roll yield. You can see that here. We got the VX30, the VIX roll yield. It is positive, about half, 50th percentile. And the decay factor is in about the 50th percentile as well. So down 0.35. So what you could do, if you wanted to sort of mimic something that I'm doing really quick for yourself, remember the VXX decays about, on average, minus 2.38% per day. But that's including all the spikes and all the down periods. So in this case, I would actually favor my VXX crush level metric at minus 0.35. We're actually decaying a little bit faster than the long-term average right now. So what you could essentially do is just type in the current NAV value of the VXX, which is 2543. So I'm going to type in that, 2543, and then I'm going to add minus 0.35. That is the decay factor. And sorry about this spreadsheet. This is going to be super annoying for you guys. This spreadsheet is basically broken. So it beach balls all the time. I just haven't had time to transfer it over. So give me a second here. When it snaps back in, we will adjust those prices. We will forget the fact that there is circular references all over this spreadsheet. This thing goes back many, many years, and it's basically done for. So I have to transfer all this over. There we go. So 30 calendar days, in this case, is actually 21 trading days. So the NAV, sorry, what I should do, I messed that up. I should be doing the indicative value. That's what I meant to do. I think it said 2197, didn't it? 2183. Sorry. You're going to have to watch this stupid spreadsheet do this beach ball again. 2183. Update that. Wait for the Mac to catch up. It's actually not a Mac problem. It's just my life as a person who has enormous spreadsheets. So 21 days later, we're actually expecting it to be down at 2028. So again, you don't have to do this. If you have basically a no opinion on the VXX going forward, you could just use that 22 strike or 21 strike. But technically speaking, it's probably going to be about 21 or 20 if the VXX decays at its normal rate. So now you're looking at a trade like this, 2120, right? This amount right there is the IV. It is the actual NAV. This amount is what we're essentially factoring in. Over the next 21 days, the VXX will probably decay a little bit on its own anyway, even if Barclays didn't do all this mess. So this is actually where we're expecting the price to be. And this is a quant-style trade. If you have a different opinion, that's fine. I don't tend to overlay my personal opinions on top of my trades. I tend to do things by the numbers. But this is sort of a trade that would look good. And then the one thing that I like to do, I don't like to trade $1 strike gaps. So sometimes I'll just bump it up to $2 strike gap, and essentially this is the trade. So it'd be risking $61. Hopefully it decays a lot. Hopefully Barclays announces and fixes this thing and we get a big gap down, and there you go. This trade could potentially sort of break even here, and then if we get additional decay, it would go a little bit further. So right now, the VIX futures are in contango, but not strongly. So this is why I'm saying over the next 21 days, dead even on that strike is about 2050. This is the mathematical expected place that the VXX will be 21 trading days from now. I'm taking a trade with a little bit of directional exposure on top of that. So this is the one that I'm looking at. Now, before I actually execute this and then just open it up to questions, I'm going to see if my chat section is moving again. Does anybody else, get your questions in now, and we'll get to them in a second, but does anybody disagree, agree, like the trade, not like the trade, want to do something different? Maybe we can run a few simulations on something that you thought was a little bit better. But if you want to see how it's executed, another thing that I typically do, and you don't have to do this, but for me, typically for options trading, as far as scaling, I typically go about 1% of net liquidation value. So I will take 1% of my entire net worth. That's what I mean by net liquidation. All my investable capital, I will take 1% of that amount and I will allocate it to a trade. Some trades, If they're very slow moving iron condors or something, they can be higher than that. But that is sort of a standard, not risk trade, but, a trade that I'm basically willing to let this sit there and die because I have to keep this thing open until the announcement. There's no reason to monitor this in a normal trade. If I don't get the gap down, I am way outside the money, and it would take a near miracle for the VXX to move that much. I need that gap down. So this trade is probably going to bleed capital on me. It's going to just go down and down and down and down, and it's going to look really ugly. And then one day I'm just going to wake up and I'm going to see that, oh, wow, Barclays fixed this. Maybe it's 2 weeks from now. And it's just going to gap down and it's going to fix my trade. It's going to look bad for a while and then it'll get fixed. And if it doesn't, all the money's gone. So that's why I have to keep this at a very reasonable level. And I always feel like 1% is a pretty good range. So just full disclosure for everybody, I will do 1% of my entire account. This is just a live trading for our chats, like for our live streams. I will also I want to let everybody know, just so you think, if you're going to take the trade and mirror me, you probably want to know that I did take the trade. So I will go to Interactive Brokers as well, and I will take the trade with my portfolio. This is live capital, but I'll be taking more contracts than that. I just want everybody, because a lot of you know that I have two accounts, and I don't want people screaming in the chat like, oh, you only took it in one of the accounts. I will go back later, but let's try to scale this. So all you really have to do is just risk $2,650. So, what would that be? I don't know. Let's just start guessing here. 30. Let's go to 2,442. That's close enough. 42 contracts of that trade of the 2119. Let's see how close we can get. Now, the VXX is bouncing around. It's moving quite a bit. I don't know how executions are going to be. This is going to be interesting. I've actually never traded during one of these things either. So this is a learning experience for all of us right now. But I'm going to open a vertical. I'm going to adjust the strikes to 2119 like we said. And I'm going to adjust the contracts to 42. So that is 1% net liquidation of this account. 62 is the mid, 74 is the natural. So I always tried it for the mid, right? Thinkorswim's very good. So the listed price is good. Interactive Brokers, not so great. So sometimes you want to sort of like bump it up a little bit and try to do a little better. And, go the other way. Just to see. I'm not going to get it because Thinkorswim's very good. I'm just using this as an example, just to show you how fast it is to price these things. So we're going to fire it off, and we're going to see it's not going to go through, right? I went down the other way. I have to actually pay more because this is a debit spread. So what you just do is basically, I would wait 30 seconds, and then I would adjust the price, but it's a live stream, so I'm not going to wait that long. I'm going to go up 2 and see if we get that, and we did. Like I said, I would have probably, if I cared about the pricing that much, I would have gone to 61 cents, waited 30 seconds, gone to 62 cents, waited 30 seconds. But we got it at 62, which was the mid. Like I said, Thinkorswim, the price that they show, it's actually quite accurate. I know a lot of people say, well, their software isn't. Schwab, Fidelity, I don't know. Tastyworks, whatever you use. But the trade went through, and now I have 42 contracts of this thing expiring in 30 days. I'm hoping it gets to $18.99, like 19 bucks. We're right here. It's going to gap down to here, and it's going to really help my trade out. And then hopefully in 21 days, my natural decay factor of the VXX is going to kick in at 35.35% per day. And boom, I'm going to nail this trade exactly. So that is, in a nutshell, how I would take a trade. Those are the things that I consider when I am trading. I would do more. There's more calculations I could have done. But just to give you an idea, I typically don't just say, I feel this, I'm just going to, boom, there's the trade. There's some thought that goes into it, some calculations, a lot of spreadsheeting, a lot of metrics. Like I'm bringing all of my volatility dashboard metrics into the equation. If I did do the iron condor, for example, I probably would have brought one of the other metrics in. I probably would have brought the VIX minus volley residual in. And I would have decided if this number is very high like it is now, that means the out of the money activity is pretty high right now. So I would have probably been better off. You can decide whether a straddle or an iron condor is the better trade. There are other trades that I could have done. If I'm doing a butterfly, I probably would have wanted to know how much the trader's VRP is elevated. Essentially, once you have your own little volatility dashboard going and you understand all of this sort of vol complex as a whole, you can start to price your trades quite accurately. And now, luck of the draw. Let it go. It's out of my control now. So trade is on. We'll definitely update that thing as we go. I do want to hear some feedback from people to see if they were agreeing with me. Do you think I missed something? Is there some glaring error that I didn't factor in? Let's get into it. So Q&A section. There was a lot of questions, so it's almost 2 in the morning for me here, so I don't know how long I will be going before I fall asleep, but let's fire off. So Lisa, thanks for joining. One thing, everybody, again, if you haven't already, please click the like button. It really, really does help me out. I don't know why. It just does. Videos get shown more, and YouTube likes that when people engage. So, all right, what price should we expect to pay for the UVXY Butterfly? So I assume you mean the butterfly that we opened yesterday in the vol trend strategy. So if you want to see what I paid for it, remember the pricing is going to be dependent on what time of day you took the trade. But this is, again, a 1% net liquidation value trade, UVXY Broken Wing Butterfly. If you want to see what it actually looks like in a picture real quick, this is the trade. Basically, the UVXY is trading here, and we are trying to lead it as a short vol trade into the range. We just don't want it to go all the way over here. Now, of course, if it does go all the way over there, no problem. I'm long 2 times the Dow, long 1 times real estate. I'm long 1 times utilities. So kind of no problem. If the VXX really decays fast, I don't really care, but I'm more expecting it to be in this range. So as far as what I paid for it, remember it was a debit spread. So it's a capital outlay to open it. You can see here the trade price, the short strike is double. You can see there's 48 contracts there and there's only 24 of the long strikes. So you basically double this premium to 110 and then subtract the 117. So I paid 7 cents for this trade. Now, I was keeping an eye on it throughout the day. So what I saw, when I sent the email, it was about 4 cents or 3 cents. It fairly quickly jumped up to about 6 or 7 in that range. And of course, I take my trades later on. As you know, I like to be the last person in line. I don't front run anything. I'm actually market close type of person. I let everybody get their trades in and then I get them in at market close. And I got 7 cents. So I would say the range that I saw throughout the day was about 3 cents if you got really lucky on the timing, up to you might have actually had to pay as much as 8 or 9 cents. I did see there was about an hour or two there where it looked like you'd have to pay about 9 cents. So that might sound like a lot, like, oh, I wish I got 3 and I got a terrible trade at 9. I mean, law of large numbers, long term, if you take 100 of these things, it's going to work out 50-50. There's going to be some days you get the best price of the day. There's going to be some days you get the worst price of the day. Don't attach to that and get emotional about it because it is totally luck of the draw. During the intraday trading, random noise. There's no possible way that I can know or anybody can know. Forget all those people on Twitter who think they know. They don't know what's going to happen in the next hour. They just don't. So I just don't really worry about it too much. I just open my trades. I get the price that I get. And I don't go back and check and say, oh, man, I got 5 cents worse than I should have. I don't do that. So I got 7. Hopefully you got 3. You might have paid 9. That's probably the range that I would think is fair. If you got outside of that range, email me because you probably executed it wrong. That's what I would say. Here's one person. Tim is saying 9 debit. Not sure where he got his credit from. Are you saying somebody got a credit for that trade? That doesn't sound right. AJM said he got a credit for 9. Probably you just mean debit. You paid 9 cents for that. That's on the high end of what I saw, but that's perfectly reasonable. Still a good trade at 9 cents. It's a good trade at any price. Remember, it's the structure. We're trying to guess essentially the UVXY decay factor over the next 2 weeks. And unless the market switches its current trend, we can basically calculate where it's going to be in 2 weeks. It's really just a mathematical equation at that point. So whether you paid 3 cents or 9 cents, it's going to hit the range or it's not going to hit the range. And over time, you'll get some good ones and some bad ones. Okay. You've often said not to short VIX ETPs outright. Yeah, I hope I said it a lot. You should never, ever take undefined risk in volatility ETPs. Ever, 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 full stop. Hopefully I made that clear. Why? There's going to be a cyber attack at some point. I don't mean to be grim. I don't want to scare anybody. There's going to be a cyber attack at some point. There's something crazy is going to happen. There's going to be another Volpocalypse. There's going to be an October 87. There's going to be an unbelievable 1% interest rate hike. There's going to be, a wild change of political positions overnight, or just insert bad thing. If you're taking undefined risk, it's just a ticking time bomb. Remember, investing works based on long-term relative percentages. Dollar values don't matter. If you start with 1,000 and you have 100 amazing trades in a row, and then you have one catastrophic trade, you've lost all your money. It does not matter that you made 99% win rate. If that 1% crushes you, you lost all your money. And so remember that day is lurking. And we all have to just structure our portfolios to know that someday we're going to wake up to a massive gut kick. And you want to make sure when it happens, it's going to hurt. And it's going to probably hurt all of us, unless you got lucky and you actually profited from it. For some reason, you happened to be long vol at the time. It's going to hurt. Don't make it worse by taking undefined risks. So yes, sorry to spend so much time, but I love every live stream making sure I say that. It is not worth it. Plus, defined risk option spreads take way less capital to open. So you could probably open 7 or 8 butterflies for every naked UVXY call. And of course, you're going to make way more money on the butterflies. So it's also just a dumb thing to do mathematically. It's kind of a rookie trade. People who don't really understand options and capital efficiency, they tend to sell naked options. They don't really realize that if they just calculated the profit loss on defined risk, you'd make more money and you'd actually take less risk. So I'd say calculate more if you're tempted to do that. But let me finish this question. God, I'm lingering here. All right. Do your equity curves for vol trend, tactical vol, etc. reflect P&L when holding the ETFs outright? Well, I never short the ETFs outright. So or the option strategies taken on the ETFs. So what I will say is that my reported performance is always exactly what the trade is, including the fees. So that trade that I showed, that's not part of the VTS portfolio, but let's just say it was. I will calculate exactly what the end of day prices are for that trade, including the trade fees, and that's the performance that I report. So if that trade, we opened it today on March 23rd. I'm in Taiwan. I'm in the future right now, so I think it's the 23rd for you guys. End of day pricing today is what it's going to be marked at. Now, again, it's not an official trade, but if it was. And then the day we close it, end of day prices on that day. That's how I calculate performance. Essentially, what I want is when people look at my performance over the last decade, that is exactly what you would have gotten if you followed the trades that went out in emails. There's no, hey, I used 2 p.m. I got a good price that day, sue me. It's none of that. I'm using end of day prices for a decade exactly. That's the performance that people get. So, but I don't ever take ETF short positions ever. Okay, biggest risk to your strategies. I like where this is going. Is it possible volatility metrics ever stop working, or that whipsaw signal lag keeps increasing in the future? Yeah, this is something that, I always say play devil's advocate. Try to imagine scenarios where your strategies would stop working or your portfolio would run into trouble. And for me, my portfolio is structured entirely different from what you would probably have ever seen anywhere else. So the risks that I face are different than the risks that other people face. For me personally, the biggest risk to my portfolio is not what most people fear. It's not market crashes, because we can go long and short. It's not, massive drawdowns over a week or two period, because we cycle out into safety very, very quickly. And my portfolio is extremely well protected risk management wise. But there is a hidden risk to my style of trading that maybe some other styles are not subject to. That's how it works. Everybody's got strengths and weaknesses, right? You just have to pick the best thing. For me, whipsaw is the danger. So what I mean by that is you move out into a trade. Like let's say the market's crashing and I move out of equities and I go into bonds. Gold, better example. I go into gold. Well, I'm never going to get hit with an equities drawdown that's down like 15, 20%. I'm always out fairly quickly. But what happens if I get out of equities and into gold and I lose money on that trade? And then the next day the market reverses and I get back into equities and I leave gold and I lost on that trade. And then you keep going back and forth and it's little pennies, it's little paper cuts here and there, but it can actually start adding up over time. So that for trend following strategies, that would be the risk, is that you essentially you suffer like 6 months or a year of seemingly tiny losses here and there, and then they add up over time. So no method of asset management is ever without its risk. And I would say that's the biggest risk for me personally. I don't know if that makes sense to you. You'd have to see it functioning to actually really understand why that's happening. But it's because trend following has the inherent weakness of requiring thresholds. There's no way of getting around it. You have to draw a line in the sand and you have to say, my strategy says I should be doing X in this market and Y in that market. And there's a crossing of a line there. The danger is you just keep doing this back and forth. So not everything I do is trend following, right? This is why I really have to get after it and get into my cave, so to speak, and get back to the VXX Options community, because we've got 10 strategies there and many of them are counter trends. So it can balance things out. You don't want to have your entire portfolio trend following. You don't want to have your entire portfolio contrarian. You want to have a mix of both. And I do have a healthy mix of both. It's just in the last, I've just been overwhelmed with emails, unfortunately. I am just a one-man show and I got bogged down. But yeah, to answer your question, I'm not at all worried about market crashes. I'm actually not looking forward to it because people get hurt in a down economy. But yeah, whipsaw is not my friend for sure. Okay. Greg says he paid 8 for the contract. About right. I paid 7. Broken Wing shortly after the email came out yesterday and used the same strikes. Okay, so we kind of covered it. 3 cents to 7 cents. CAT scan. I see what you did there. Yeah, funny. If selling options has no general edge, why would you still trade the wheel strategy? I didn't say selling options has no general edge. I said that blind selling of options on a calendar schedule has no edge. I don't know if that's what you mean by this, and we're just arguing about semantics here. But what I'm saying is that let's say I'm just going to sell 30 delta put options every 30 days. I'm going to sell them on day 30. I'm going to close them on day 7. I'm going to rinse repeat on day 30, and I'm going to do that for 5 years. The expected profit of that strategy is 0% minus trade fees. You've done nothing. There's no edge whatsoever. The options are priced efficiently enough where if you're selling the premium, you'll have a bunch of easy wins, you'll have a high win rate, and then you'll have some losses that are pretty large, and it'll offset, and you're expected to make 0% minus trade fees. Same on the long side. If you just buy long straddles just over and over again, every Monday you buy it and every Friday you sell it and you just keep going. Or short vol people, if you just sell a naked call on UVXY every Monday and you close it or sell it every Friday when you see the new options and then you close it the next Friday and you just roll them, 0%. There's no edge there. So what you need to do is you need to actually apply some knowledge, and every little piece of edge that you add to the trade can add a little bit of expected profit. So maybe you understand a little bit better than other people how options work. We'll award you 3% edge for that. Maybe you understand how to scale your portfolio really efficiently as far as sizing. We'll give you a 2% there. So now you're expected to make 5% over time. Maybe whatever. Maybe you have very good pricing, right? Maybe you're just doing something really well there. Maybe you have really good predictive metrics or something, and you're actually able to predict 70-30 instead of somebody else's 50-50. You've got an edge there. There's another 3%. But you have to add things up, right? You've scouted out for the cheapest trade fees possible. There's a little bit of an edge. You'll get more money there. It's all kinds of things you can add. But all I said was blind trading on a calendar schedule with no edge added. For the last 15 years, the options market's way too efficient for that to work. It's just there's no edge there and it won't work. So hopefully that clears it up a little bit. How did you fix your email issue? Can we still email you? Yes, you can email me. The way that I'm fixing my email issue is I'm just trying, I lost my, there we go. That looks a little nicer. I'm trying to look at my service with fresh eyes, right? I've been doing this for so many years. Or I launched officially in January 2012, but I had been doing it publicly and sharing all the performance for 3 years before that. So I've been doing this for over 13 years. And everything has just added layers on top of what I've already done. So now if somebody joins my service today, it's a little bit overwhelming for them. I mean, I didn't fully recognize how confusing it might actually be for new people. So what I've tried to do in the last, say, 6 months or so is just see things through the lens of a new subscriber who is totally lost, and no wonder they ask 25 questions when they join, right? Of course they're asking all the same questions I've answered 1,000 times before. I'm an extremely patient person, so I always answer every question 1,000 times over again. But I actually don't have to if I just clean up a little bit of it. So better welcome video, better, just better stuff. Clean up the website. You probably noticed some changes to the website. There's no need to have 15 different pages for all the strategies. I basically want to just direct people to watch the strategy videos, because you'd be surprised how few people have actually even watched the strategy videos. In many cases, I have more paying subscribers than I have views on my videos. So it's just a matter of trying to get people to watch the content that I'm creating. And I think I'm getting better at that because the email problem is fairly quickly diminishing to a level that I can handle these days. I'd say I'm only answering emails for 2 to 3 hours these days, where it got to a point where it was like 5 or 6, 7 days a week. I just can't forward the business if I'm spending 6 hours a day answering emails. So it's on me. It's all my fault. I can totally sympathize with somebody who's just asking questions. They didn't know I made a video in 2017 answering that exact question, right? They didn't know that. So yeah, it's all on me, but I will fix it. I'm a trader, right? I never intended any of this to happen. I don't know how to really, I do now, how to manage a business and stuff, but I make mistakes all the time. It's just comes with it. Eventually, this is an arbitrage, the VXX thing, I assume. There should be people who take advantage of it, sell VXX and buy VXY or the futures. Yeah, I would imagine there's a lot of people who are trying to crunch numbers on ways to do this. And depending on your access to short and long shares, like shorting VXY, I've heard that shorting UVXY is problematic lately. I don't know where the additional volume is going to, but arbitrage and pairs trading might not actually work. So one of the biggest dangers of pairs trading, I'll warn you if you're actually thinking of doing that, like pairing two different things against each other, you have to remember that the margins of each of these things might change on you. That'll cause problems. If you are short something, you could lose your shares at any time. Those could be called away. There's all kinds of variables that are out of your control when you start doing pairs trading. So I typically, as an entry-level trade, would say just stick to a single ticker and try to structure something there. If you're trying to do this over here and then hedge it in an equal value with the futures, and then, it gets complex pretty quickly. And we're talking about something that is already 2 layers. VXX itself, best of times, it's a hard product to trade. And now we have to add in Barclays, and then you have to add in 2 different markets, and the calibration of the hedging and the arbitrage back and forth. Boy, that's it's hard to get that right, for sure. This is interesting. Do you mean today? Gregory says, I tried to buy the VX. Oh, you tried to buy the VXX on my option account and I was denied. You tried to buy the shares of the VXX and you were denied. That surprises me, but I do not know. I've never bought anything that was no share creation, delisted, pink sheet, nothing like that. I don't know. That sounds... Is that right? You can't even... Yeah, you can still buy it, right? I don't know. Yeah, of course you can still buy it. I don't know. You might want to check your broker there. That sounds odd. Not a lot of action on VXX. Trading intraday 100% of the IV with people on margin and forced liquidations all around. I don't know if any of that is true, but it sounds like it could be. In my humble opinion, there was too much action to be legally allowed. I feel you. I know exactly where you're going with that. It's wrong what they did. It's wrong and it's rotten. That's what it is. Unfortunately, these are very large institutions with teams of lawyers and a lot of access to capital. And just take my word for it, they've covered all their bases. So everything they do behind the scenes, I know this is a rotten thing for somebody to say to you. It sounds like you had a bad experience. Actually, Igor, is that you? Yeah, I think you did have a bad experience. Yes. So if that, yeah, I mean, I'm sorry, whatever happened, it sucks. But the truth is, they can really do whatever they want. Now, obviously, outright fraud happens occasionally in the financial industry. I mean, honestly, outright fraud that somebody is actually held accountable for, that's the trick, that's very rare. I mean, even during the financial crisis, I mean, how many people were held liable? I think there was that one random person who didn't even really do anything wrong that was punished for it. But yeah, it's a terrible thing to say, but every legal out that they have is stated somewhere in very, very fine print, buried somewhere in a prospectus that at some point was emailed to you when you signed up for a broker. At some point that happened, and it only has to be proven that it happened, not that you read it. So I know nobody reads those. I mean, most people just send those to junk mail, but unfortunately it was in there because the bank is just never going to open themselves up to lawsuits. So it's going to happen again. That's why I like to do these things. I like to warn people ahead of time. If you are long this product, ticking time bomb. Do not think that there is somehow going to be a situation where you don't get your profit ripped away from your account. You're just going to wake up one morning. They're not going to do this during trading hours either. You're just going to wake up one day and pre-market, you're going to see your account. And if they do pre-market for you, you're going to see that mark of what your net liquidation value is, and you're going to be like, well, what is going on? Where's my money? Well, boom, it's going to go down there. There's your money. Remember in 2012, history is our guide here. In 2012, they wiped $300 million off of TVIX in 1 second when they resumed share creation. Well, 2 days, but a good chunk almost immediately. It's going to happen again. Trust me. It's going to happen again. So this is when I asked. Now I can see them all. That would have been kind of fun to ask people a question, but yeah, it looks like everybody here. It looks like my whole audience are geniuses. That's awesome. Okay. Are you consistently able to get those favorable prices you want for your butterflies? I can never get close. Not sure if it's broker liquidity issues or just the saturation of the vol options market. I mean, I don't get favorable prices at all. I'm a retail trader. For all intents, I'm a retail trader. I have negotiated with interactive brokers, but I pay TOS prices just normally. I mean, my account, that TOS account's not big enough to get preferred pricing. My interactive brokers, it's not really a size thing. Sometimes I notice that you can just email and ask them, and that's what I did years ago, and they said yes. So I actually got that tip from somebody else. He said, all you have to really do is just email them and ask them if you can get reduced pricing. And surprisingly, they just said, yeah, sure. I did that on PayPal recently too. I was like, well, I don't want to pay whatever the percent they take away from me. Can you reduce that? And I got an email within 2 days from somebody saying, absolutely, we can, work with you. And they gave me some options and they can reduce the price. So, I mean, go ahead and ask, maybe you'll get it. But just to be clear, I don't get favorable prices. I paid 7 cents because at the time I traded, it was 7 cents. Perhaps what you mean is you're not very good at getting fills. So again, what I would say is you look at the mid price, and if you're trading with a broker where in your experience the mid price is not an accurate mark, then you need to open a thinkorswim trading account. You don't have to fund it. I think you can put $20 in it. I can actually show you that. Like this account, hopefully this thing is still open. I don't have to log in. This account, yeah, it's still going. So if you look at 1 year, no, let's go back farther. You can see what happened in this account. I opened this, I believe, in 2006 or 2007, something like that. And I traded at thinkorswim for about 5 years. And then I moved over to Interactive Brokers in 2011. And I took all my money out except $35. I kept this account open with $35 in it for like 9 years. And then you can see I funded it with like $10,000 and I started trading like a little $10,000 just to keep it going. I just wanted to try a VTS option strategy of mine, and I wanted to show people how it works over a year. So I traded for like 9 months or something on $10,000. And then I just funded it just for the live streams. This is the first basically week we started doing live streams. But do this. If you have a broker that kind of sucks for pricing, make sure you do this. Put $35 in a TOS account just so you have access to thinkorswim, and then you'll know what the market's supposed to be. Then you go in when you're doing your trade and you get close to that, but try to do a little bit better. So if you're selling something, try to sell a little bit higher premium. If you're buying, say it says 60, try to buy it for 58, 57. Wait 20 seconds. These are computers. It goes very quickly. You don't have to wait for an hour in front of your computer. Wait 20 seconds, bump it up a penny or two. Wait 20 seconds, bump it up. That's how you get the good pricing. I guess the key is to know and have confidence that the mid price it's showing you is actually the mid price. If that's the case, then you will always get the same pricing as me. I am not advantaged in any way. I'm just a lowly retail trader, just like all of us. We're in the same boat. No risk that the options market for VXX is halted if Barclays doesn't come back soon. The options market has nothing to do with any of this. No, the options market will be fine as long as the product is going. Now, if they do actually accelerate the product, that's the word they use, but terminate the product, which I highly, highly doubt, then in that case, what would happen is they will mark the price to the indicative value. Remember that. They are not going to buy people out at the NAV value. People are thinking, wow, they bought me out, lucky me. No, they're going to mark it back down to the indicative. Again, they're a bank. They've got all their bases covered. They're going to give you that minimum price, that indicative value. And then, of course, the options would no longer exist. Market makers wouldn't be making a market on anything, and the whole thing would fizzle out and die. I don't think that that's what's happening. I really, really do believe this is just a temporary 2 to 3 week difficulty securing, basically hedging premiums that they want to pay. Now that in itself is shady, right? You set up a product, you let it go, you basically agree it's an ETN, we're going to mark this, it's a debt obligation, we're going to do all this stuff, but then as soon as something happens and you don't get the premiums you want, now you can just say, well, I don't like that price, so I'm just going to shut down for a little while. Yeah, you know, it'd be nice in a perfect world if they were sort of forced to manage the products in some way, but they just aren't. They can just say, well, I don't like those prices. I'll just take 2 weeks off. It's terrible. It's really bad. But legal. Unfortunately, legal. I like the idea of putting the long strike at the IV personally. Yeah, on the long put butterfly or on the long put vertical, putting the long strike at the IV, and then I guess you're saying you don't want to price in any of the VXX decay, which is fine. The market's very uncertain right now. I don't know what it is. Last time I checked, it wasn't looking great. I don't, I mean, of course, goes without saying, nobody knows what's going to happen. But the market could be at all-time highs in 2 weeks. I could totally see that happening. And it could also completely collapse. It could totally fall off a cliff here. So if you just want to take it as a net zero VXX decay and just mark it at the IV, that works. I mean, options trading is so fun. I like going through that process that I did. I think that's a lot of fun to crunch the numbers. Hard to see numbers on the toss screen. Do you mean when I'm screen sharing? It's hard to see this. I will watch the rebroadcast. Is it possible I'm not in 4K? I should be in 4K. Can you not see these? Or I suppose if I show you the actual trade, is that what you mean? You can't see those numbers? I will look into it. Sorry about that. What is the best way? Okay. I had to pay 10 cents. Yeah. I don't know. I wasn't sitting in front of my computer the whole day. I will definitely admit. But I saw 3. Somebody got 3, I'm sure. What is the probability of a sudden crush of UVXY that jumps past the profit tent in our UVXY? I mean, if you're asking me about the actual percent chance that that happens, based on the implied volatility, 26.03%. That's the, I mean, that's the odds. That's the odds that Thinkorswim platform, the algorithm here, is giving. So I'll go exactly here. You can see right there, 26.05 that it breaks even. And right at 11, there is a 17.03% chance that this trade goes from where it is today all the way through and into the loss. There's a 17% chance of that. There is a, let's see if I can add a slice for you here. There is a 18% chance that we're going to expire here, and there's a 53% chance here. So essentially what we do is we kind of, we like to layer these trades. So let's go to the trade. We're in the first layer here, and I'll wait a little while, and then I'll add another layer, and then I also have the ability to add additional layers with what's called the overlay community. And so essentially we're trying to throw out a pretty big tent where a lot of these trades start making their profits, at least little profits. And over here is, of course, the risk of max loss. But like I said, if the UVXY is at 11 2 weeks from now, the rest of my portfolio will make a lot more than this trade loses. So I will be covered in that sense. And I almost, not quite, because we're not fully allocated to net long equities yet. We're only 2 times leveraged here and 1 times leveraged here. So we're not fully engaged. But basically, I'm almost daring the UVXY to go that far. I would actually like to see it just crush. That'd be pretty cool, because that would mean that our portfolio is going to do very well in that situation. 17.03% chance is the answer to your question. But that's according to the TOS algorithm. Yes, we use SVXY in the aggressive vol strategy, have for years. It's deleveraged, and I just continued using the deleveraged version of it. So from 2012 to 2018, I used the full -1 times SVXY. And then when it deleveraged, I didn't, well, actually we did. We doubled for about 2 months. We doubled the position, took a loss, decided that this whipsaw environment's too bad, and we went down to just use the SVXY, and have for a long time. I don't know if you know that or not, but we removed that strategy last month, and the only reason I removed it is because I have to make some changes to it, and I don't want to just do it on the fly. I want to have enough time to focus on it, so I just removed it out of the portfolio for a little while. It's under maintenance, we'll say. It's not gone. That's good for you. The answer is no. I read all the prospectus papers. Doesn't everyone? No. No, they do not. Like I said in last week's live stream, though, if you want to be a volatility trader and you're committed to this process and you know that this is going to be an up and down battle, and you're going to have bumps and bruises, and you're going to go through periods where you think you're a genius and it's so easy. You're going to go through periods where you just can't believe how bad luck you're getting. Every time you go this way, the market goes that way. Every time you do something, oh, this is the one, it goes the other way. You're going to have it all. So if you're just committed to the next 10 years, do yourself a favor, crack open a bottle of wine, get those prospectus ready, and just read them. Just read through them all. Understand the product, watch a few of my videos that talk about the details of the VIX futures market. Do yourself that favor. It's well worth your time to be as educated as possible, because this can either be one of two things. It can be a golden opportunity. If you're a very good options trader, it's a skill you can carry for life, and it can change your life. I mean, not to be too overly dramatic here. I know I'm not curing child cancer or something, but teaching people how to be effective investors is life-changing for people. I mean, having more financial security is opening the door to being a healthier person. I mean, health costs money. Good food costs money. Gym memberships cost money. All of those. Having free time so you're not working 12 hours a day and overstressed, that helps. All of that financial stuff. Later on in life, being able to pay for friends and family members to get medical treatments, that's not going to be cheap, and it's going the wrong way for us. The key is to figure out a way to be a successful investor. And if you commit to the process, it can be a golden opportunity, like I said, but it can also be a disaster. There are all kinds of ways where people can you can lose decades of your investing time horizon by doing something stupid. Remember, taking a big drawdown, it takes a long time to recover from. If somebody rode down the financial crisis, it took 6 years, inflation adjusted, just to break even. And if you rode down the dot-com bust, it took 15 years to break even. Who has that kind of time? Who has that much to just waste like that? And then if you make the mistake of using leverage as well, then it can take 30 years. I mean, you can either make this the best thing in the world, or you can make it a total disaster. Obviously, there's some middle ground there. You don't have to be the best or the worst, but you get my point. Do yourself a favor and study these products and make sure you know exactly what they are designed to do. Okay, this is interesting. Sounds a little bit self-serving if I answer this. Watch all the streams. You're not a subscription member. You don't have to be to follow the education. Is there value in your strategy for someone that mainly trades futures? Again, this is going to be the self-serving part, because on the one hand, I would tell you, yes, the actual thing you trade is the least important part of what I do. The most important part is the timing and the sizing, the portfolio sizing. So the timing of the ins and outs and moving from equities to gold to utilities and structuring it all together, how you actually execute the trades is up to you. So if I have a strategy that goes net long equities, well, you can execute a net long market exposure position in any number of different ways. You don't have to actually buy the Dow Jones ETF that I do, for example. So at the risk of being self-serving, yeah, I think so. But I do zero marketing, so I'm not gonna twist anybody's arm. There is a free trial. I mean, you can always just try it. I should actually just link that for everybody. Why not? Let me throw that in the chat section. I mean, everybody here who's never seen what we do behind the scenes, just come on, enter button. My enter button's broken, so now I need a new computer. That's fun. There it is. Give the free trial a shot. There seems to be, on the YouTube channel, there's way more questions than I can see on my screen. What is DDM? DDM is the 2 times Dow Jones ETF. 2 times leveraged Dow Jones. Why did SVXY crash so hard in 2018? Well, that was Volpocalypse. You've probably heard that word thrown around a lot, but essentially SVXY crashed 95% from Monday, February 5th to market close 15 minutes after 95% down. Now, it was only down about 35% in regular trading hours. So it was a devastating day. The VIX index was up 115% that day. It was devastating. 35% loss in a minus 1 times inverse product is a lot. It was the record at the time. But then the aftermarket rebalancing happened, and all of the leveraged products have to buy the same futures, right? This is something that kind of confused a lot of people. They're like, well, isn't it a net zero game? Well, it's actually not, because the inverse products have to buy the futures in order to hedge their positions, and the long leverage products have to buy the same futures in order to maintain their long exposure for the next day. So everybody's out there buying the same futures, and the VIX futures market was way smaller than it should have been compared to the size of the volatility ETP market. In 2014, Volpocalypse wouldn't have happened. The vol ETPs didn't have the size to crash the VIX futures market. But in 2018, the short vol trade was all the rage, and it was a very crowded trade, and there was $5 billion in AUM in the vol space, in the vol ETP space. VIX futures just simply couldn't handle a rebalancing like that. So it went from down 35, and in a 15-minute rebalancing after markets close, boom, it's down 95. And of course, XIV was terminated. They both have the right to terminate. SVXY, I guess, took a really big chance and actually didn't terminate and benefited from it, because the next day it was a big Vol Crush day, and then they survived. So that is the story of SVXY. It was a really bad day in the market, but it shouldn't have been even close to being a problem for the vol ETPs. It was the aftermarket rebalancing. And to head off your next question next week, it's not a problem anymore. The vol ETP space is significantly smaller than it used to be. So we're not expecting to see a Volpocalypse again, at least not now. Okay, do I have a plan to get out of Taiwan quickly if the communist China launch sudden invasion? I don't know if this is serious or not, but this is one of those little, one of the differences between Western media and actually living in the country that the media is reporting on. A lot of the people that report these things, I guarantee you they've never been to Taiwan. I'm here now, I'm sitting here. I've been in Taiwan on and off for 15 years. So, I mean, I have family here. I can tell you with 99.99% certainty there is not going to be any violent invasion when that happens. I know the Western media likes to paint this picture that we are in somehow a target and we're next, and maybe Russia worked out a deal with China behind the scenes where they get Ukraine and, you know, China gets Taiwan. That's not going to happen. There's absolutely no desire to defend or go to war or any of that stuff. It's just a different situation. Taiwan will not like it. I mean, I'm not saying they're going to be thrilled about it, but if that day did come where the China just decided, okay, now's the time, they'll reach a diplomatic solution. People on, a lot of people would be happy about it, because joining a country that is the future like China, I mean, it's not all bad, right? There's a lot of people who would be disappointed by it, but I'm telling you, don't believe the hype. We're not in any danger of being, bombed or anything like that. That's not how it's going to happen. It's going to happen diplomatically. Would you like to get a Taiwan gold card to make your residency status as good as possible? Well, I don't mean to say this in a bad way, but as long as my wife doesn't divorce me, should be good to go. Should be fine. It's not citizenship, but it's the next best thing. So let's hope I treat her well and she decides to keep me in this country. But I also, legally speaking, I don't like to get into it too much of my situation, but I'm also a resident of Panama, and I will quite soon be a resident of Dubai, and I just like to do that to have options in this world. So I'm not worried. Yeah. I can duck out. I'll be safe. Don't worry about me. Thanks for your concern, though, and turn off that Western media. It's absolute garbage. Every single one of those channels is garbage, whether it's the blue channel or the red channel. I mean, it's just all trash. Do you suggest Taipei as a trip for digital nomads? Maybe 2 months stay? No, I hate to say that because I'm here, and no, I wouldn't. If I had to suggest something, I would say go somewhere else. I would say go to Japan. I'd say Korea would be a better choice. And it's not that Taiwan isn't great. It is. It's very Western feeling. It's forward looking. It's extremely safe. It's just, I mean, you can go anywhere at night and you just feel completely safe here. It's super convenient. There's everything you ever need it's way more convenient than North America. So it's fine. It's just not particularly fun. Like as far as a tourist destination, it's just not that, like, you know, it's not Dubai. It's not, you know, going to Switzerland or Norway or something. Japan is just, there's so much more to see and it's just much cooler. I've been to Japan a lot. Never been to Korea, but I've heard it's decent. Thailand, nothing wrong with Thailand. There's more fun in Thailand, more scenery, more beaches, more golf, whatever you're into. Taipei is awesome, but it's a city. Like it's just people live here. They don't play here. So I would say, unfortunately, no. Okay, I'm going to answer one more. How a day before the Volpocalypse I was supposed to know that SVXY is a crowded trade? I didn't even know the VXX aggregate short interest. Oh, that's a tough question to answer without sounding like I'm being derogatory. How are you supposed to, like, I may be of a different mindset than a lot of people, so I'm certainly willing to acknowledge that what I'm about to say might only apply to me and a few other people. But I personally wouldn't dream of trading a product that I didn't understand. I just wouldn't be able to wrap my head around the math of the trade if I didn't know what it was and how it worked. So how are you supposed to know a day before Volpocalypse that it was a crowded trade? I mean, I have a metric that I track that I don't really share because it's not an issue anymore, but it's actually quite simple. I actually showed you here, basically. All you do is you just take the VXX daily volume and you multiply that by the NAV value of the VXX. And you're essentially talking about how much money is going through this product. So that's $1 billion. You could do this in a spreadsheet extremely easily. And in fact, I mean, you don't even need a high-level trading software. You can just, what am I doing? I can't see my keyboard because my microphone's in the way. You can go to VXX, for example, right? We'll just go to this. That's not it. VXX, normal VX, what is going on? What is going on? I have to do this the old school way. There we go. VXX. Go to historical data on Yahoo Finance. It gives you the volume. So, I mean, all you do is just multiply this by this, and that's how much money is going into it. And then the biggest 3 or 4 products, you do the same for UVXY. Back in the day, back in 2018, you would have had to do TVIX. Nowadays, TVIX is trading on the, on the junks, but you wouldn't do it there. But you basically just understand your product. You understand the general size of the volume of the VIX futures market and the general size of the Vol ETP market, and follow me on Twitter. On February 2nd, before Volpocalypse, I went on Twitter, not just once. I tweeted for 6 months straight that this was going to happen. Not that day. I didn't predict the day. I just said that something like this is going to happen. And people called me crazy. And on February 2nd, when VIX futures went into backwardation, I went on Twitter all day long. I was telling people, be careful. This is not a time to be short vol. Don't do it. I didn't know that the very next day it was going to do it. I'm not claiming to be Nostradamus, but it was, if you understand the product and how they work, again, I'm not trying to be derogatory, but you got to know your products. These are super complicated things. This is not Apple stock. It's just not. These are complicated products with moving parts and counterparties and behind-the-scenes hedging and swaps being traded back and forth and mechanisms of tracking indicative values and all. I mean, it's just, there's layers to this. Don't trade anything you don't understand. That is a very good rule. And again, I'm very sorry if you lost money. That is terrible because, of course, who could have predicted it would get that bad? Although I did write an article about it. So follow me, follow my stuff more. I don't know. Self-serving again. Hard to answer those questions because on the one hand, the answer is simple. Don't trade what you don't know. On the other hand, that's an insulting thing to say to somebody. So I apologize if that came off the wrong way. I didn't mean it that way, but it is the truth. Understand, read the prospectus, follow me on Twitter. All right, I am going to go to sleep. It is 2:30 in the morning, and that was a long one. So my trade's on. You guys can mirror it if you want. You've still got a little bit of time, or you can just take one of the other ones that we talked about. There was 6 of them that I covered. Have a little bit of fun, get a little bit of exposure if you like. I think I've got a little skin in the game. It's enough for me, 1%. I will go take my IB trade and then go to sleep. So thanks, everybody, and we'll see you next week.